Imagine a stock that just surged over 40% in 2 weeks, basically riding this massive wave of AI momentum.
Oh, it's been an incredible run.
Right. But then you look beneath the surface. Executives are actively selling their shares. The business is burning cash at just an astonishing rate. And Wall Street analysts are actually calling it 33% overvalued.
Yeah, that's the paradox right there.
Exactly. So the question we have to answer today is Navitas Semiconductor, ticker NVTS, is it a hidden gem that's about to break out, or, the ultimate value trap just waiting to crush retail traders?
I mean, we are looking at the absolute definition of a battleground stock today.
Totally. But before we unpack this wild ride, make sure to like the video, subscribe to our YouTube channel, and leave us your feedback in the comments. It is compulsory if you want to keep getting these insights from us.
Yeah, let us know what you think, because the mission for this deep dive is to tear into both sides of that battle.
I got through the noise, right?
Exactly. We are evaluating the current state of NVTS as of today, April 20, 2026. And to do that, we have to look at the raw financials, the real-time technical analysis, and this really intense bull versus bear debate happening right now.
Because it's just everywhere. I want to frame this as like a case study for a broader market phenomenon we're seeing, the whole AI halo effect.
Oh, the halo effect is so real. It's driving everything.
It really is.
Yeah.
Because the contrast between this stock's explosive short-term momentum and its sobering long-term financial reality is just jarring.
It's night and day.
Let's look at the vital signs. Right now, NVTS is trading at $12.32. It's down a tiny fraction today, like 0.4%, but over the last 2 weeks, it is up huge.
And the volume proves it. The momentum is just undeniable.
Yeah, we are seeing over 36.6 million shares trading hands recently. And the normal average is closer to what, 21 million?
Roughly 21.9 million, yeah. People are just hyper-focused on this ticker right now.
And that extreme focus has created a wildly unpredictable trading range. I mean, if you look at the 52-week history, the low is all the way down at $1.73.
Which is basically penny stock territory.
Right. And the high stretch is all the way up to $17.79. It's a completely bipolar chart.
It really is. And at current levels, that puts the market capitalization at roughly $2.84 billion.
Nearly $3 billion.
Yeah. But when we pull back the curtain and, look at the actual income statement, that valuation becomes very difficult to justify based purely on current operations.
The gap between the valuation and the actual revenue is just staggering to me. I was looking through the trailing 12 months, and for a company worth nearly $3 billion, it only pulled in about $45.2 million in revenue.
Which is tiny compared to the market cap.
Exactly. But that's not even the wildest part. The net income for that same period is a loss of nearly $117 million.
Negative $116.95 million, to be exact.
Wow. So that translates to a diluted earnings per share of negative 57 cents. Let's just pause and think about the math on that for a second.
That's not pretty.
No, it's brutal. For every single dollar they make, they are losing over $2.50. A net profit margin of negative 254.71%.
Yeah, that's a tough pill to swallow for fundamental investors.
Okay, wait. How is a company operating with that kind of structural cash burn? Are they just burning the furniture to keep the house warm, or?
Well, the income statement alone would definitely suggest they're on the brink of collapse, but the balance sheet tells a completely different, much more resilient story.
Okay, what do they have in reserve?
You have to look at their assets. Their total assets are sitting right around $500.7 million, and that's against only $56.81 million in total liabilities.
Oh, wow. So they aren't desperate. They're actually pretty heavily armed.
Very heavily armed. They have a massive cushion. The working capital is over $207 million.
That's a lot of runway.
It is. And their pure cash position is extremely strong, sitting at $238.6 million.
Okay, but they're still bleeding cash, right?
Undoubtedly.
Yeah.
Their annual free cash flow is negative $44.37 million, but with nearly $250 million war chest in the bank, they have a substantial runway to operate at a loss.
Right. Well, they try to execute their new strategy.
Yeah.
So having almost $250 million in cash isn't a sign of survival mode. It's a calculated long-term war chest.
Exactly. They are spending money to pivot the entire company.
But what are they shooting at? Because, I mean, you don't get a 40% surge in 2 weeks on a negative 250% profit margin unless there is a phenomenal story attached to the stock.
Right, and this brings us back to that AI halo effect you mentioned. The market is ignoring the massive operating losses because Navitas is undergoing a fundamental pivot.
Moving away from what they used to do.
Yeah, historically, they built their foundation on mobile power chargers, but, the mobile market is saturated, it's low margin.
So what's the new play?
The pivot they're executing right now is a hard shift into high-efficiency gallium nitride and silicon carbide chips, often referred to as GaN and SiSi,
Okay, and why does the market care so much about GaN and SiSi right now?
because these specific materials are becoming the absolute physical bottleneck for the future of artificial intelligence.
Okay, I want to break down the mechanics of that for you listening because
Okay.
it's crucial to understanding the bull case here. Traditional silicon chips have been the backbone of electronics for decades, right?
Sure, yeah.
But when you were dealing with modern AI data centers, we're talking massive clusters of thousands of GPUs processing trillions of calculations, traditional silicon just hits a physical wall.
It literally cannot handle the heat.
Exactly. The power requirements are so astronomical that standard silicon components overheat, they melt down, and they waste a massive amount of electricity simply as heat exhaust.
Think of standard silicon like a two-lane local road. It is perfectly fine for everyday mobile phone traffic.
Right.
But an AI data center is like forcing 1,000 heavy freight trains down that same two-lane road simultaneously. It bottlenecks immediately.
That's a great analogy. So gallium nitride and silicon carbide act like what, an 8-lane superhighway?
Exactly. They have a wider band gap. That means they can handle significantly higher voltages and temperatures.
And switch power on and off much faster.
Yeah, at much higher frequencies with virtually zero resistance. This lets you deliver massive amounts of power to AI processors cleanly and efficiently.
Without needing a whole power plant just to run the cooling fans.
Yeah.
And the Navitas is specifically developing these 800-volt to 6-volt power supply boards, right?
Yeah.
Tailored directly for this new AI infrastructure.
Specifically geared toward the NVIDIA GTC 2026 platform.
Oh, man. When you put NVIDIA and AI data center infrastructure in your corporate guidance in 2026, the market instantly treats you like you're selling the pickaxes during the gold rush.
It's the ultimate buzzword combination.
And it's not just talk. They even brought on new strategic leadership. Gregory M. Fischer joined the board of directors recently.
Right, which signals a serious, experienced push toward actually executing in this high-margin industrial sector.
So the narrative is incredibly powerful, but we have to separate this long-term technological promise from the short-term market mechanics.
We really do.
Yeah.
Because the 40% surge we've seen isn't just long-term investors politely buying in.
No, not at all.
There is a purely mechanical, highly volatile factor driving this price action right now. The short interest.
This is where the setup gets genuinely dangerous. We have short interest sitting at a hefty 22.9%.
Almost 23%.
Yeah. For a stock with this much visibility and a daily volume of 36 million shares, that isn't just a bearish bet, it is a powder keg.
It really creates this forced buying mechanism. When nearly a quarter of the tradable shares are held short, those traders need the stock price to go down to make a profit.
Right. I like to compare it to shaking a soda can and waiting for the tab to pop.
That's exactly what it feels like.
Because if the stock starts ticking up, whether from an NVIDIA partnership rumor or retail traders swarming, those short sellers start bleeding capital.
Rapidly. And it triggers a vicious cycle.
If the price rises too high, brokers force those short sellers to close their positions, right? To prevent infinite losses.
Yes. And the only way to close a short position is to buy the stock back at the current market price.
So you have regular investors buying the stock because of the AI hype, and simultaneously, panicked short sellers are forced to buy the stock to cover their losses.
All of that buying pressure acts like rocket fuel. It drives the price up exponentially, which just forces even more shorts to cover.
The algorithms catch the momentum, and suddenly the stock price completely uncouples from the actual balance sheet.
That short squeeze dynamic really explains the explosive volume. But if the underlying business is bleeding that heavily, we need to look at the real-time psychology of the tape.
Right, transitioning from the AI story to the actual chart signals. Let's look at the technical analysis.
The charts have to be showing us how traders are positioning themselves when you strip the emotion away.
Well, the short-term trend has been aggressively bullish. The stock is trading roughly 28.4% above its 20-day simple moving average.
Which is sitting down around $9.13.
Right, so a massive premium. It's also well above its 200-day simple moving average of $8.59.
And this is all following a golden cross that happened back in June of 2025.
The golden cross is such a crucial psychological marker. That's when the short-term moving average crosses above the long-term one, right?
Exactly. It represents a fundamental shift in market sentiment. The moment short-term traders transition from fear to greed.
They're suddenly willing to pay a premium. And the MACD, the momentum indicator, is also currently issuing a buy signal.
Based on the recent volume, yeah.
Let's map out the support and resistance. On the downside, we have initial support at $10.51.
And a much stronger floor down at $9.40.
Then on the upside, resistance is at $12.38, running up to the recent high of $12.87.
Which brings us to the reality check. Because despite the technical momentum, the chart formed a pivot top on April 16.
A pivot top. So the momentum is fracturing.
Right. It suggests a high probability of a short-term pullback. The buyers are losing conviction at these elevated levels.
Okay, so the chart is flashing some warning signs. What about Wall Street?
The analyst consensus definitely does not support a breakout. The consensus rating across the board is a mere hold.
Just hold. I dug into those analyst price targets, and this is where the bearish reality check gets very loud. The average price target is $8.15.
And the stock is trading at $12.32.
Right. So that implies the stock is currently about 33% overvalued.
Which is a huge disconnect. Now, the targets do have a massive range.
Yeah. The high target is $13, and the low is $4.20. But the median consensus sees it as wildly disconnected from reality.
Analysts can be late to a pivot, sure, but there is a piece of news regarding who is actually buying and selling right now that is critical.
Oh, this is the part that really caught my eye. The SEC filings.
Yes. Notable insider selling.
Explain that, because it's a huge red flag.
The data shows that Navitas executives dumped roughly 98,000 shares in late March.
Right near the recent highs.
Exactly.
I have to ask a paraded question here. If the AI data center narrative is a sure thing, why are the insiders cashing out their chips while retail traders are piling in?
That is the multi-million-dollar question. Now, insiders sell for mundane reasons, taxes, buying a house, diversifying. But a cluster of executives selling right at the top of a massive 40% run, it screams caution.
It implies the people with intimate knowledge of the actual timelines and bottlenecks think the stock price has outpaced the reality. So let's synthesize all of this into the ultimate debate. Undervalued gem or value trap. Let's lay out the best case versus the worst case scenario.
Okay, I'll take the bull case, the best case scenario. Navitas executes this pivot perfectly.
Okay, what does that look like?
The shift to higher margin AI and industrial sectors pays off. Revenue from the new data center contracts actually converts successfully on the income statement.
Real cash, not just hype.
Right. And the combination of the new leadership and a short squeeze drives the stock well past that $13.09 upper medium-term projection.
Basically, the market realizes that burning cash was a brilliant way to capture market share before legacy companies could pivot.
Exactly. That's the dream scenario.
Okay, well, let me counter with the bear case. The worst case scenario. Extreme valuation multiples clash head-on with these persistent net losses.
Because you can't sustain a negative 250% margin forever.
No. If the broader AI hype cools down even slightly, investors will stop buying the narrative and start demanding present-day profits.
Which they don't have.
Right. And if those massive R&D and operating costs drain the cash runway, the $250 million cushion evaporates.
And the stock tumbles.
Violently.
Yeah.
Back toward that $8.15 average target, or even lower toward the $4 floor.
Which perfectly highlights the brutal psychology of a retail value trap.
Explain the trap, because I think a lot of people fall for this.
Because of the massive AI optimism, regular investors suffer from FOMO, fear of missing out.
Oh, absolutely. They see the green arrows.
They hear the buzzwords, they read about the short squeeze, and they buy at the top of these 40% surges, say at $12.80.
Assuming the fundamentals will naturally catch up.
Right. But then the momentum fades. Institutional money shifts to the next ticker, and short-term weakness takes over.
And because the business is losing over $100 million a year, there's no fundamental floor to catch the falling knife. The retail trader is trapped holding the bag.
It is a very high-stakes environment right now.
So, wrapping this up, let's look at the outlook. Short-term like, days or weeks, expect consolidation.
The technicals suggest we'll see it bounce between $11.50 and $12.50.
Right. Digesting the gain ahead of a massive catalyst. The May 5 earnings date.
Where a loss of -6 cents per share is projected, by the way.
Yeah. But honestly, the reaction will depend entirely on management's forward guidance about actual AI revenue conversion.
Exactly. And medium term, 3 to 6 months out, is highly dependent on that cash flow. The projected trading range is anywhere between $8.42 and $13.09.
It's just massive volatility, which is why I need to firmly remind you listening right now. We are just analyzing the data and the debate today.
We are not telling you what to do.
Absolutely not. This is absolutely not financial advice, just a deep dive into the information at hand. You have to do your own research.
Especially with a battleground stock like this. And I'll leave you with one final provocative thought drawn from the options data.
Oh, what's the options chain showing?
It shows that institutional big money is heavily, aggressively positioning themselves for that May 5 expiration. They are placing massive bets.
Preparing for explosive movement either way.
Exactly. So with earnings just around the corner, insiders taking profits, and a massive 22% short interest ready to ignite.
The ultimate question.
Right. Are you watching the actual fundamentals of Navitas, or are you just trading the AI hype?